Good morning, ladies and gentlemen. Thank you for joining us. You're there, we're here. It can mean only one thing. It's yet another live, interactive advice show coming to you from the Tower of Power at the top of Simplybiz Studios here at our secret location, deep in the heart of the city. My name's Dan Russell. Thank you very much for joining us. We've got an action-packed set of shows for you today. Later on today, we're going to get stuck into a retirement special, looking at all of the latest happenings in and around the retirement market. We're going to take a look at cash in the advice process and what advisors can and should and could be doing with clients' cash as an asset. And we're also going to take a look at some of the latest developments in the world of advisor technology and creating efficiencies in the advice process. However, for the next hour, to start us off, we're going to get stuck into a market review. And you may or may not have noticed, the eagle-eyed amongst you will have noticed that there's just been an election. So we're going to get stuck into all of the impacts and the consequences of what's been happening over the course of the last few days. And in order to do that, I've pulled together a crack team of people to bring you all the insight you need, strong and stable insight about everything that's happening in the markets. We've got Paul Rutland from Prudential. We have Ken Rayner of Rayner Spencer Mills and the brains behind those verbatim RSMR model portfolios. And we've got John Husselbee from Liontrust, head of multi-asset, co-head of multi-asset investing at Liontrust, and the man behind the running of the FP verbatim active fund range. However, important as these guys are, not as important as you, because you can drive where we take this conversation. You must have some burning questions about what on earth's going to be happening out there in the marketplace, given elections in France, given some fun games over in the States, and all of the stuff that's been happening here recently. I intend to see this fruit-based device in front of me melt with the number of questions that are being sent in. So, fingers at the ready, get typing, and we shall begin. Gentlemen, we're looking for strong and stable leadership, apparently, and the country has voted for a hung parliament, and the stock market seems to like it. What's happening? John?
Well, as my granny would say, I think the country's in a right old pickle at the moment. Yes, I mean, I think in terms of the result, it certainly was a surprise, but equally it is what the markets were expecting. In terms of, if you look at sterling, it fell a couple of percent. It didn't plummet the 10%. All these words used on the media about plummeting. Well, I don't think 2% is a plummet in terms of sterling. So when we have political events like this, which we seem to sort of have more and more of, it tends to be the large liquid capital markets where you see all the action, and you've seen it again. So you've seen it through in sterling. In the case of the US presidential election, you saw it through Treasury bonds. So you've seen it through sterling, you've seen the weakness in sterling, and that clearly has a knock-on effect to the FTSE versus the mid-cap. So we saw the FTSE up, we saw the mid-cap mildly up on Friday, and then you've got to work through, well, what does a weaker sterling mean? Well, it's actually quite good news for obviously some of those companies which are obviously trading overseas, but it also puts more pressure on inflation. So, more pressure on inflation, which puts pressure on bonds. So you have all these knock-on effects. But, I'm not surprised by what has happened in markets. And, and for the long term, I'm not really sure that these large political events actually make much difference at all.
So John's suggesting that it was all baked in. Everyone saw this coming.
Not quite.
Well, I'm not sure they saw it coming necessarily, but certainly the markets were well prepared for a change. I mean, we expect the unexpected, I guess, now, isn't it? That's what's happening. We get political votes, we get populism coming through, and certainly from an analysis of the vote perspective, it looks like the younger element of the population made more of an effort to vote this time and voted, for Jeremy Corbyn and Labour. So that wasn't unexpected, I don't think so.
Paul, what do you think the implications are in terms of the underlying mechanics of a set of the investment solutions that are out there at the moment at Prudential? Is this something that causes huge consternation the day it happens, or does it really just bounce off the surface?
Well, I think we need to recognise that this was something of a political shock, probably not in the last couple of days before the election itself, but it was something of a shock. We weren't necessarily expecting a hung parliament. And these shocks seem to keep happening. They seem to keep coming along, don't they, whether it's the Brexit vote or Trump being elected. But markets have taken these shocks so far in their stride. There has to be a concern that at some point, whether it's around the German elections or whatever it might be, that markets will stop taking those shocks in their stride. It's fair to say that the UK market is a relatively small percentage of the global market, and as a consequence they're more affected by what's happening in the US and in China than they are around UK elections. But our expectation is we'll continue to see some volatility in the market, partly driven by exchange rates, and you would expect me to say this, Dan, but the thing that Prudential brings to the party, of course, is our ability to smooth out some of those peaks and troughs in short-term returns.
I thought you were going to say strong and stable for a minute. John, what's the key drivers then? If it's not political shocks, what are the fundamentals that you've got your eye on in the global economy?
Well, I mean, just going back to the election for 1 minute, and in terms of the focus on the economy just wasn't there at all. If you looked at the campaigning, the economy wasn't mentioned at all. And it worries me a little bit that perhaps politicians on both sides of the house don't really understand the mechanics of the economy. So if there is a concern out there, that's one big one. And as being suggested here, at the end of the day, UK market is less than 10% of the world by in terms of equity market and also by terms of economy. So, to focus on that 10% as we would do, it's quite insular. We're reading it in the paper, it's on the newscast every 2 minutes of the day. To focus on that would be wrong. And, most portfolios have a good deal of international diversification about them. They're investing overseas. So therefore, you are capturing that sort of 90% of the opportunity. And it's a different world we live in now. Different world we live in terms of the goods that we buy, the goods that we consume. They're not all manufactured in the UK, and they haven't been for a long, long time. So if you want to basically, keep up with the pace of inflation and the pace of growth with the goods and services that you buy, and keep your sort of standard of living up, you basically do need to have that international diversification. And that's been around in portfolios for a very long time. And perhaps it's only now that really people perhaps are beginning to realise the benefit of that. So once again, post Friday, portfolios have had a lift up depending on how much global exposure they've had. So yeah, I'd agree always it's about the economy and inflation and those parts of that sort of sets the tone, sets the path for the portfolios. The global recovery remains still on, perhaps to some extent equity markets have sort of perhaps rallied a little bit too far. I mean, there's always an expectation of corrections in markets, a 5-10%, sort of correction or pull down in the market, is to be expected. The trouble is, and the challenge is when, and who knows where that will be, and who knows what will trigger it. I mean, but I think there's got to be some pause of breath. If you looked at the chart since November the 8th, it's pretty much been going up in a straight line. And so, in normal market conditions, you have some sell-offs. And so we should expect one, I would have said.
Just taking on John's point there, actually, our analysis of what the managers have been monitoring certainly is an increase in cash holdings. I think, John, you probably increased yours as well in terms of verbatim, and I think certainly we've seen on a multi-manager point of view, there's a lot more cash being held on, waiting for opportunities. I don't think necessarily last week was an opportunity as such, but nevertheless, there's certainly more out there. Yeah,
it just feels better, doesn't it? I mean, the basics of investment management are buy low, sell high. It just feels better to buy when there's been a bit of a sell-off in the market. The only challenge with that is, the sell-off in the market maybe when it's 10-20% higher than the moment they've made that decision. So it's a little bit sort of chicken and egg in that respect. But Just
so talk about that cash position a little bit more for us then. What movement have you been making?
Well, just basically letting as money comes in, just basically letting money sort of sit on cash rather than investing it. Simple as that, really. We've had some good flows over the last sort of 6-7 months since taking on the portfolios and increasing the activity, as out and about. And we've had some flows, and we've just let that settle into the markets. Said only on the basis that nothing really looks super cheap. Over a sort of a medium longer term, Asia and emerging markets look very good value for us. But, will there be a better buying opportunity? Well, maybe so. But as I said, the danger of playing this game and you let cash go too high is that, by the time you do get that correction, you might have missed out on a 20% gain.
Yeah. What's the cash position for you guys then, Paul?
I was to say, Dan, from our perspective, in the With Profits Fund, which obviously feeds through into all of the Pru funds, the cash position has been relatively high for us. It's been as high as 6% during the year. Having said that, we can't sit on 6% of 85 billion for too long in cash. And as a consequence, we are looking closely at other assets that look attractive to us, alternative assets, for example, infrastructure projects, and property. Bricks and mortar property, we think, is a good place to be. We've long since been fans of property, but the market seems to have recovered well from that property tantrum in the summer of last year. Cash position is higher than it would normally be, but we are looking for opportunities at the moment to invest, especially into alternatives and into property, and to a lesser extent into, as you say, John, Asian equities and the UK as well.
Now, Ken, within the model portfolios that you're running, you've not obviously got a unitised position where you're holding the assets and making those decisions, but is there a play in here for the model portfolios in terms of how you're positioning them?
I don't think what happened last week has changed anything from that perspective, because we were slightly underweight those areas that you'd expect us to be, which are government bonds, that kind of thing, where we perceive there'd be no value there, and slightly overweight in Europe and Asian equities, as many consensus views are. But not to be too far away from the main allocation, because I think that that's that strategic allocation that will return most of the returns over the longer term. So we don't try and push too hard on that. So we didn't make any changes coming up to the election, even if we'd have assumed there was going to be a Conservative majority, which arguably when it was first called you would have thought that was the case. I think one of the things that does come out from a European perspective, though, is that in the press over the last couple of days, should I say, we've seen a lot of talk about how this may create a softer Brexit than was originally anticipated with Theresa May's stance, as it were. So I think we may look to Europe to be a bit more controlling in terms of how they deal with us and Brexit. And also, from a business perspective, we've seen markets rally a little bit on the basis that there hasn't been a huge amount of change, but also because we can see this a softer Brexit, a better business Brexit. Us negotiating effectively for a deal which allows us to obtain the open market with Europe, and also maybe have a little bit of flexibility around migration and supply of labour, which is another issue for business.
So Theresa had been very clear that Brexit means Brexit. Could it be that Brexit doesn't necessarily mean Brexit, and what impacts do you think that has?
Brexit to me is a little bit like playing the hokey dokey, and I don't know whether my left arm's in or my right arm's out. I mean, it really is quite soft or hard. You're either in or you're out. At the end of the day, who knows? I don't think we know much more now than we did a few months ago, and I don't think we'll know a lot more in the next sort of coming months, or until sort of the negotiation has happened. That clearly is a challenge for UK business, and it's a challenge also for European business, I would suggest as well, trying to work out what it all means at the end of the day. However, as Ken is suggesting, at the end of the day, one thing that you do need is labour, and you need skilled labour. So hopefully we're not sort of closing and shutting down the door in that respect, because we have a long history over the years of when we require that labour of acquiring it, and coming in from overseas, and getting the skills that we require. So, I do think that to some extent, it just shows. I mean, the danger with answering all these sort of questions is you end up sort of like in some political debate, which I'm definitely not qualified to talk about, but I have my own opinion about it. But it just shows once again there's perhaps that the government, once again, and perhaps the opposition on both sides, do feel a little bit out of touch with what actually is going on within business. And I think it's always a fair criticism, which has been in terms of the MPs in our parliament, the number who actually are in business or have been in business and become MPs. As far as I can see, I think, in this latest election, there's even less of those than there were before.
Okay. The thing I would say around that, John, is that, yes, we know that Mrs May has said Brexit means Brexit. What we've never quite found out is what Brexit means because that could be a negotiating position. It's clear that Mrs May and her supporters will want a deal that's good for British business. And I think that needs to be a working premise for all of us.
Yeah. Got a question in from David Jeffries. Hi David, thank you very much for sending in. We've sort of covered a bit of this, but this puts it into a nice succinct question. Stock markets at all-time highs plus major uncertainty in politics equals stock market crash due. Should we bank profits now?
Is it a yes or no? I think, look, I mean, it's where you are in terms of your own personal investment cycle. You know, for me, equities are for the long term. I don't see, famous last words probably happening as we speak, I don't see a market crash around the corner. Do I see a sell-off of 5-10%? Yes, I do, because we see it all the time. That's just normal part of equity business. You know, just look back over the years, you'll see it all the time. Drawdowns 5 or 10%. We had one in Asia and emerging markets. You know, mid-December, we used that to our advantage to top up Asia and emerging markets in doing so. So, you know, I do expect that. To find a major crash, what we've got to look for is some sort of oncoming global recession. And at the moment, that doesn't seem to be on the cards, with most people thinking higher growth, you know, higher inflation and higher bond yields in that respect. You know, the data to look at, you know, there's plenty of it out there to see whether you've got, you know, oncoming recessions. The 2s and 10s is a classic example of that, where you look at the yield on 10-year gilts or treasuries, and then you look at the yield on shorter term bonds, 2 years, and you look to see basically where that's trading at. At the moment, it's around about 1%. If that starts plummeting towards zero and negative, then it's a good early indicator to say that a recession's on the way. You can't see that anywhere around the world, and other things to boot as well. So you still got plenty of monetary easing going on. Mm-hmm. So you've still got plenty of money sloshing around, you know. And I think you really, where you have to put the brakes on is if you see that next recession, because that tends to coincide with you know, with bear markets. We use history, of course we do, and we like to sort of start comparing the past, but you know. It's a good starting point, but not necessarily does it dictate the way that things pan out. So
you see, he said he wasn't wanting to have a political discussion. However, what he did do was challenge the assumption of the question, just like a politician, which I thought was very good. So let's. Jane Hodges has been in touch. Jane, hi there. A regular contributor, and thanks for joining us again, Jane. A very similar set of questions, really. Do you think that a hard or soft Brexit is best for the country, and why? And many investment gurus say that the markets, particularly an American one, is heading for a massive crash.
Well, I think actually,
challenge the assumption of the question.
Well, the question I want to answer is no. I think that John's quite right. The markets feel very toppy in terms of multiples. So you're talking about the US being, you know, sort of 20 to 25 times. You're talking about the UK 18 times, with some scope to move a little bit, I think. And Europe and Asia, obviously, we've already discussed, slightly lower. So that's where, you know, systematically the value lies. However, I think what's coming through from you know, the soft and hard data is that, you know, the consumer data is a bit more positive, but the manufacturing data, etc., is a little bit more negative. So those two are a little bit contradictory. So uncertainty there. I think also you've got this, you know, the fact that America is doing so well and interest rates look like they're going to go up again in the US. In fact, that's baked into expectations over the next year, you know, two weeks or so when they have their meeting. So we expect certain things to look like things are more positive, but fundamentally the earnings sessions in the US have been quite good. So that's suggesting again that the American economy is still quite strong. So I like John, don't see a 20 or 30% fallback in markets on the back of what we've heard so far. We have been 8 years into a bull market though, so you know, all the stats, all the data, all the chartists are saying, crikey, we've gone further than we've ever gone before, even in 1920, before we had the 1929 crash. So therefore, there must be something big happening. But it doesn't have to be like that. We could be in a new, let's call it a paradigm, whatever we want to call it. We could be in a new era where this steady low growth is something which continues.
Just picking up on Ken's point, he's quite right. Of course, price earnings ratios look high, especially in the US. Yep. Valuations look high historically, but there are some fundamentals that support. Earnings revisions have looked good. They're genuinely going up, and as a consequence, there is still momentum behind equity prices in both the US and the UK. Our particular view is that US now looks expensive, and wherever possible, we're taking the opportunity to trim back slightly. Do we expect a crash? I would agree with the other two speakers, not. But some sort of correction, very, very possible.
Okay. Well, we've moved over to the US there, so let's take a little global tour. Pack your bags over the Atlantic to start with. We've got the view there that the US is looking a bit overvalued and a bit toppy. What's driving your thoughts on the moves you're making in the States? And where, John, for example, within the verbatim portfolios, where are you positioned relative to the strategic asset allocation on cash on American assets?
Yeah, I just want to pick up on a point that Ken made in terms of PE as well, which I think is interesting. I mean, Ken, you do a lot more of in terms of interrogating of fund managers than clearly we do in terms of that. When we talk about PE in markets, I find more and more now that actually not many fund managers use that measure at all. They're using a lot different other measures. I just wonder whether that's something you're finding, because we all talk about PE is expensive, the markets look expensive. You sit down with a fund manager and say, oh, the PE looks expensive on your market, and they go, well, it's not a measure I'm looking at. I'm looking at other measures in terms of different metrics.
I think moving away from that generic description of what's happening in markets, they would argue, I'm sure, what the right thing to do is it's the companies that count, and the companies are investing, and therefore, if you look at the US, going back to your sort of a question, Dan. If you drill down into what's causing the market to be so high up, then it's the Facebooks, it's the tech sector, which actually, funnily enough, has just had a wobble in the last few days. If that goes down, then if you like that area of the market, the Nasdaq, if you like, goes down, then I think that will see a big correction in the US market. Maybe not significant, but certainly a correction. If you look outside of that, then you can get good companies on decent PEs in the US even. So it's sector related. The energy sector, for example, massively undervalued. Some contrarian investors, some contrarian managers looking to take advantage of that, because there's certainly opportunities there. So I think that you can't just assume a market is at a certain level, even though we can basically describe the US as high. If you look into the individual sectors, there are definitely pockets of value there. So, and every manager will tell you that. They won't say, oh, we're looking at the overall market, therefore we're not investing in America. They'll be saying, well, there are sectors in America where we can invest. So, yeah.
Okay. Right, back to that question.
Sorry, I hijacked your chairmanship here. Yeah, back to it's for me. We've talked about the States. It is. I think you've got to look to see where the various economies are in terms of country regions around the world, and clearly the US is at the head of that, the head of the cycle in that respect. So, for me, that makes the US perhaps a little bit more expensive than it should be. Then behind that, Europe, Japan, Asia and emerging markets, that's where we're finding the medium to longer term value. When it comes to the UK, what puts me off about the UK to some extent is the FTSE, the large caps, and that sort of 20-25% devaluation we've had in sterling, which has basically been good for FTSE stocks, and they've never had it so good. So, that sort of puts me off thinking, which direction can that go in? Clearly it can weaken further. Found that out on Thursday. But I would have said that we're at the lower end of the ranges for most of these things. So I think for me, just sticking to the same old script, which is emerging markets and Asia, not underweight in bonds, but not totally out of bonds, because diversification is, for me, still works, and diversification means that when one asset class is going up, there's a high possibility that another one will be going down.
So what sort of funds are you finding look good in the States? What's in your portfolios at the moment?
Well, we tend to look at our portfolios from the point of view of having a core and then a satellite. So you're looking at holding something which is pretty much market driven. So a tracker fund would be an excellent sort of base to start investing in the US. It's cheap, obviously, and it gives you that exposure to the market generally. And then looking for those funds which have got alpha in them, so that can generate greater alpha. So we look at funds that operate in particular styles and try and combine those together to deliver something in the States. So that's how we kind of think about markets and think about how we expose ourselves to them. Because taking the long-term view, it's not something, being a strategic investor, we're not going to suddenly chop and change between holding a particular growth style or a value style just because the market suggests that something's going to happen. We can't do that. We couldn't possibly change, and nor would we doing our clients of verbatim investors any value in doing that, because we'd be chopping and changing, costing them, and then usually what happens in these cases, you're behind the curve anyway. So you've got to anticipate what that kind of long-term return is going to be and stick to that.
So is it with the outlier? You've got your core of the passive. I'm always fascinated by this. What drives the decisions to which passive? Because I believe that that's as active a decision as an active fund manager. So I'm a big believer there's no such thing as active or passive.
Yep.
You've still got to actively choose which way to track the market.
Yeah, I totally agree with you. I don't think there is such a decision as active and passive. It's about how much weight you have in that particular market. That's already an active decision, and then where you go to actually invest in that way. So, for example, we'd be looking for, if you're tracking the market like the S&P or something like that, then you might as well go for the cheapest alternative with a good provider. I mean, there's no point in looking elsewhere, really. Then after that, clearly cost is a value, but to get the best alpha, to choose the best managers, sometimes you have to pay a little bit more for that. And if you're prepared to accept, if you understand their process, understand how they work, and that longer term view, then that's our thinking. We don't use that in every market. For example, emerging markets, we probably would never use a tracker because we don't believe that's the way to gain access to that market in the right way. So there's certain markets around the world where you probably feel a bit more, I feel more comfortable using an active alternative.
Okay. Right, let's take our private jet, clearly, back over the Atlantic into Europe. Ian Slinger's been in touch. Hi, Ian. Is the Italian election perhaps more important to Europe than our own, given the rise of the Five Star Party and their Eurosceptic stance? Let's use that initial question as a delve into what's happening in Europe. Is there value there? Do you like it? What are you up to in Europe?
I think in Europe, clearly after the Dutch elections and then the French presidential elections, sort of populism seems to have been dampened a little bit, and probably dampened because the numbers are starting to come through and unemployment is falling, and so therefore perhaps the enthusiasm for more of a revolution has gone away for now. But yeah, we're getting this sort of elections, and every time a result comes through which is perhaps more pro-Europe, well, that may be the case for the Dutch, but you just watch the French. Now the French comes to, that might be the case for the French, but watch out for the Italians because they've got to have an election soon. I just think that all of these things are, you've got to take it as it is today. You've got to see, what's currently going on. And at the end of the day, I do believe that economies and, Trump, all of this type of political sort of stuff that goes on. We spend a good time, and today will be no different. We spend a good 80% of our days talking about the sort of the macro political side of things, and particularly when it comes to politics. I actually think that the impact is very little. However, when it does come along, sometimes you can get quite clobbered by the shock of it. But political events don't tend to happen that often. We just so happens to sort of line them all up in a row at the moment, and we've got some leaders making some very poor choices in terms of when to go to the electorate, and things that they think they could win and they clearly lost.
Paul, are the prudential asset allocators heavily eyeing up Europe?
Well, we're certainly overweight Europe at the moment. It's one of our favoured geographical areas. I don't believe we're too concerned about the outcome of Italian elections. Italian is an important country in Europe, of course, but in terms of GDP, pales into insignificance compared to Germany. So we have German elections coming along as well. But it's a favoured asset class and geographical region of ours, and we are overweight in Europe. Monetary policy is still accommodative in terms of mainland Europe, of course, which it isn't necessarily anymore in the US and the UK. Okay, we've had a bit of a blip around the Brexit vote, but the expectation is that interest rates in the UK will start to rise quicker than they will in Europe. So for now, at least, we're still very pro-Europe, yes.
And how are you all accessing the European markets? Are you tracking with a core and satellite approach? Are you heavily in on active management? What's the approach that each firm's taking?
For us, it is that sort of core and satellite approach. I mean, it's the approach that we take when we look at the asset classes anyway. So the first question we ask ourselves is, when it comes to passive management, we have a bench. But we start from the top down. You start from the strategic asset allocation. In this case, it's DT. DT are providing strategic asset allocation based upon some market indices. Using those market indices for each of the asset classes, we can then ask ourselves the first question, which is, for that indice for Europe, or the MSCI or the FT, is there a tracker which is available and suitable? In other words, is there something that's aiming to do with what our chosen benchmark is looking to do? that's the first question. If you can do that, well, that's a good starting point. And then the next question you ask yourself is, well, is it worth time and effort to look for active management? And the only way to sort of answer that question is to look at the dispersion, look at the differences, on a year-by-year basis, or preferably over a 10-year basis, between the best and the worst. And if that gap is wide, then potentially, and I think that's the right word, potentially it's worth exploring and looking for active management in doing so. When you look at that for Europe, you can find yourself the appropriate passive funds, and you can find yourself plenty of very good active managers within Europe. I would say Europe is probably one of the easier sectors to find good active managers, and has been for a very, very long time.
Yeah, we're very much along the lines of active in Europe, I have to say. We can find, John's pointed out already, we can find some really good managers in there, managers that are not just hit and miss, but are very consistent in what they've been doing in beating their sector, in beating the market. So we find it relatively easy, if you can call it easy, to look at long-term solutions in the active space for that. We don't have a passive alternative in our portfolios on Europe, so we very much are able to derive the right returns and right products from what's available. Simple as, I think.
The question for us is, what do you track in Europe? And if you take any kind of view on Italy versus Germany or Spain versus France, for example, then do you track the underlying countries' indices, or do you just track a European index? From our perspective, it's much more about a bottom-up approach in Europe. There are sectors and geographical areas that look more attractive, but really it's about a bottom-up active approach in Europe for us.
Okay. Before we move on our journey around the world and take a look at the Far East and Asia, I've got a question from Jane Hodges again. Everyone will tell you that investment strategy is in the long term.
Excellent.
Yeah. Jane's been listening, John.
Fantastic.
But timing entry into market can make a huge difference
Correct.
in volatile markets. And a year ago, the market was just above 6,000. So what should advisors do? Consider timing entry?
I can't stand market timing. I'm really not a big fan of market timing. Look, if this is real politician stuff, if it's a question of basically you've got clients coming knocking on your door and saying, is it a good time to invest? I have a lot of sympathy with that, because whilst over the long term, data suggests that you will get a real return, doesn't matter when you invest in over a 10-year period. Clearly, there are better times to invest than others. I would say that at the moment, a suggestion would be is to make sure that you have a strategy in place, something you're going to stick to. So perhaps a strategy may be, break that money up into 3 parts. Perhaps put some money in today, perhaps then wait for your next third for that 5-10% correction, which we're all talking about and may come along. And then for your final part, basically just set a date of when you're going to be fully invested. And I think that's the best you can do in terms of some sort of market timing. It'll make you probably feel a little bit more comfortable of easing that money in. But your starting point is that if you're investing and it's for that long-term 10-year period, I would suggest, then there's never a bad time, history would suggest, to put that money in.
I think, and just on that, I think that, John made the point earlier on that it's about where you are in your cycle as well. So if you're retiring next week, you clearly are not going to put money into markets. Yeah. However, if you've got a 10, 15-year horizon, very, very different scenarios. So I realise that's almost like ridiculous in that no one's going to come to you with a pot of money when they're retiring in a week. But they will come to you maybe 2 or 3 years, and maybe you had a defined benefit scheme that they've just transferred because the value of it is so high at the moment. I mean, there's a lot of that going on. So people come in with large pots of money, 500, 700, 800,000, which they never had before. Do I invest that now, considering I might be retiring in, say, 5 to 7 years, which is the difficult time period, I think, because, we've got where we are now. You might argue that you should, just hold on for a little bit and see if there is that 5 or 10% correction. But I think my view, if it was my personal money, I'd sort of be putting it in bit by bit. I wouldn't be thinking, right, now's the time to put my big lump sum in because it's gone down by 10%. If it does happen, then maybe put some more in and gradually do it. Because I suggest that people of those kind of pots have still got money elsewhere. They've got their ISAs, they've got other sources of assets which are probably invested in the markets and have been for a number of years. And that is your exposure. Look at your overall portfolio, see what your exposure is to equities, property, etc., and work out how you should strategically make that the right value that you want it to be. So,
I think,
and I think it goes without saying at this point in the cycle to be as diversified as you can be, to be as highly diversified as is possible across however many asset classes. I'm not clearly just thinking about equities versus bonds here. And that's our approach at Prudential, to have access to 31, 32 different asset subclasses around the globe, to be as diversified as possible. And of course, if you're worried about market timing, and we'll all agree to the old adage that it's about time in market, not market timing. But if clients are worried about market timing, then either think about drip feed investing or looking at a smooth solution, such as we offer at Prudential.
I think that anecdotally speaking to advisors that I've found over the course of the last year, particularly in the run-up to and then beyond the Brexit vote, there was a whole lot of people whose clients were either asking them to move them out of markets, or they did move people out of markets. And I think it just demonstrates that you can't time it at all. And it's music to your ears, I imagine, John.
Yeah, well,
you're quite dismissive of the market timing.
I am, and also, being in personal finance is a more emphasis on the personal than the finance. If you ask me, and everyone does have, different view in terms of their timing in that respect as well. I mean, the other thing as well is, obviously the target risk portfolios that we're managing as well. It helps in terms of suitability. It helps to define the type of journey that you're going to receive, and it means that the more risk you take, the potential for return. Yeah. But clearly, in doing so, it will show you the sort of drawdowns that one can expect in trying to achieve that long-term return. So, I think that market timing and forecasting, just every sort of day, a month that goes by just means that attempting it seems to be more and more foolish.
We're nearly ready for takeoff over to the Far East and Asia and emerging markets. However, before we do, we're stuck on the tarmac for one more question.
Were you flying BA then?
Yeah. Whilst the exchange rate has boosted FTSE due to foreign earnings, what about the impact of imported inflation, and will we see this? Yeah,
that's the point I made earlier on, which was basically, the markets, it wasn't entirely a surprise for them because we would have seen, as I said, sterling plummet even more. But what does it mean? It means more pressure on inflation. Of course it does. And, that means that inflation in the UK potentially hangs around a little bit longer when you have a weaker sterling. But still, what will be the Bank of England's reaction to it? For my money, at the moment, it seems that they will be happy to think that this is temporary and not something more permanent than that, and we'll stick with rates being fairly low, and plus with the sort of Brexit negotiations occurring, then once again you want to do everything, I would suggest, to keep confidence going, and so therefore you probably risk a little bit of higher inflation and therefore, rates remain low, which once again is, I suppose, a good environment for business.
Are there levers being pulled within Prudential portfolios around inflation? Well,
of course, Dan, there are asset classes or subclasses that provide natural inflation hedges. Infrastructure being a case in point. Many of the infrastructure projects that we're involved in some cases public-private finance initiatives, where there are natural inflation hedges built in. So yes, indeed, we'll be looking for asset classes which provide that natural hedge. But I think we share John's view that we are seeing inflation creeping into the system, input inflation. RPI is currently running above 3%, as we all know. But Carney seems to be reasonably sanguine around that for the time being. But I think it's an important area to keep a close watch on.
Okay. Right, let's land on the tarmac over in the Far East. John, you mentioned emerging markets and Far East earlier as something that you're particularly focused on at the moment. Why?
Just because of the very much from the bottom up, from the fund managers that we speak to, in terms of the fundamentals. Those fundamentals look good in terms of the companies that they're investing in. Economies certainly are, there's growth there, and if there's any contagion going on in the world, it's some of the growth that is coming from the US is obviously clearly spreading across other places. I think that has helped emerging markets, and Asia in particular has been a weaker dollar. So, once again, we talk about the pound being weaker. I believe that the pound is stronger today than it was the day that Theresa May called the snap election. And so just a reflection once again on global markets that the dollar is weaker and it's not really going to be that affected by the fact that there's a hung parliament in the UK. So a weaker dollar has certainly supported Asia and emerging markets. I think that probably is the key sort of short to medium term risk to that story. But longer term, as I said, you just have to look at the way that emerging markets in Asia have lagged the US and major markets over the last 6-7 years now. There's quite a gap, clearly one or two things happen. Either emerging markets Asia moves up, or US etc. moves down. For my money, probably a little bit of both, which favours emerging markets. Right.
Okay, Paul. What's the house view over at Prudential?
Well, we agree. Having said that, we do need to be mindful of China. China slowdown seems to have gone off of everybody's agenda, but it's still there. And if China does slow more quickly than we anticipate, then there is a clear threat to emerging markets and Asian economies. But as I say, we certainly agree that in terms of risk premia, in terms of expectation of returns in relation to risk undertaken, not only in the equity markets but in the bond markets as well. We think that there's good value in Asian markets, yes, and bits of the emerging market, especially those that are not as exposed to China.
Right. So Ken, is your core and satellite approach out of the window in Asia?
To a certain extent in emerging markets, I think it doesn't work. I've already suggested that's the way that we think on that area. I think one thing to add to what the gentleman have said is that the debts to GDP ratios are much stronger or much better than they were, sort of 10-15 years ago in emerging markets. So you don't get as many countries exposed to the dollar in the same way. The dollar does obviously have a massive effect, but in terms of the short term, I think that those countries are in a much stronger position than they were, as I said, 10 years ago. So that helps at a fundamental level. Although in a crisis or a panic, clearly, that's going to go out the window like anything, I guess, in markets. So no, we tend to find that the sort of the indexes that you might track in those emerging market areas are much more difficult to quantify, and also you could end up, if you're tracking a particular index, you get involved in the larger stocks like Gazprom or something like that, and you have to hold it, and it's a massive. If something happens in Russia, you're really exposed to it. So it's better to hold an active fund in those areas, I think, than say a market tracker.
So how far and wide in emerging markets, which is such a broad term, how far and wide would a good fund that you would be looking to invest in be invested? What specifics are you looking for inside an emerging markets fund that makes you go, yeah, that's the badger?
Well, I'm looking certainly for geographical diversification. I mean, there are emerging markets fund in the sectors that we look at which didn't hold any India, and in the last couple of years you'd have been, well, they have performed the worst of all, So you've got to have that geographical diversification, I think, in there first of all. So I've got to make sure that I'm not necessarily interested in the weightings per se. I just need to know that they're exposed to that particular area and can invest in it if necessary. So a wide remit, a wide mandate is something that we're looking for, and also consistency and history. I mean, we talk about the grey-haired investor, and I think that in that area you do need experience. So we look to managers who've been doing that for quite some time now. I won't mention the funds that we use. They're clearly in the portfolios, but there are some that you just know have been there and done it and seen it and been through crisis. So that's what I look for.
You were a grey-haired investor.
Yes, I've been grey hair for quite a while.
I would be, but
I think a few years ago we all started dabbling with sort of bricks, as in the not the bricks and mortar, but with Brazil, Russia, India, and China, and we also started dabbling with single countries and all that sort of thing. But sort of way ago in the real sort of bull markets of the early noughties, but I think we've sort of learnt a lesson in that respect. Actually, you're better off, giving the allocation of country selection as well as stock selection to, exactly as Ken said, those managers with experience. I think, when I'm looking for active management, though, I am looking for conviction. So I'm not that bothered whether they have a holding in India or not, as long as they can provide me with a good reason and it suits their investment process in terms of are they going to make money for me over the long term. So I think it's the consistency of process that I'm most particularly interested in, not necessarily whether they invest somewhere or they don't invest somewhere. It's just making sure that they do it on a consistent manner. If I know what they own and how they run the money, then it makes it a lot easier to get that diversification within the portfolio, because I can then find someone perhaps equally has a conviction but in a different direction. And so I'm getting diversification, and I'm not over tilting the portfolio one way or the other.
Paul, what does emerging markets mean in Prudential?
Well, I think the key thing, as with any other market really, is to look at the fundamentals, to look at price earnings ratios, price to book ratios, dividend yields, and there are areas of the emerging markets geographically that look very attractive indeed. The key thing for us as an active fund manager, and virtually everything we do is actively managed, is to look at those fundamentals and to mandate out locally as far as possible to specialist managers in the geographical location to manage in their specialist area. So I don't want to put particular countries on this, although I do think that we need to be aware of those emerging market countries that are particularly exposed to China.
Okay. So we've had our global tour. We've about 10 minutes left. Let's get our crystal balls out if we can, and have a good look at what might be coming down the pipe. What are the things that you've got your eyes on? What is it that you are going to be checking the data for ruthlessly every day to make sure that you're best positioned? And what are the best ideas of how you're positioned at the moment?
I think one thing I'm wary of at the moment, and I think it's the same for all of us as investors, is how do I deal with the safety aspect of my portfolio? How do I deal with the cash, the bond elements, the high yield, and so on? Given where we are at the moment with yields, you get this. We saw it last week where everyone would have expected a rising yields, and some markets went down, some markets went up. So the point is they're all very, very low at the moment relative to where they've been in the last 20 years. They've been moving lower clearly, but I think for that's a big concern, because there doesn't seem to be a huge amount of value, and yet I still need to hold some safety in my portfolio. So I can't throw out the fact that gilts, etc., are a safe place to invest in a crisis point. So I need to hold some of them, but how much underweight do I need to be? Do I need to try and look at how much concentration do I place on spreads, and whether or not there's opportunities in high yield now which is safer than it was before because there's less defaults, etc., etc. So I need to have, when I'm using my allocation to safety, if you like, then I want to use managers particularly that have that ability to diversify across other asset classes within the fixed interest space. And we've talked about infrastructure. There are other areas you can go to as well in order to diversify. But fundamentally, I still need to have that safety element. I think that's what it's a real problem for us at the moment in deciding how you allocate that safety aspect to the portfolio. So looking forward, I'm concentrating on trying to make the best of that, and I think that means, although we're underweight in both credit and government debt, we acknowledge that we do have to have that safety aspects in case you get that sudden loss. Elsewhere, we've talked about this a little bit. Overweight Europe a little bit, emerging markets as well. But it's a very consensus play, and it always makes me slightly nervous that everyone else around the table is agreeing with each other. But ultimately, those are the areas of value, and at a very, very sort of basic level, if that's what you're trying to invest to gain, then you need the area of value to be invested in. So, yeah, but without going too much away from strategic asset allocation.
Okay, Ken raises a great point around the safety assets, as he calls them. What's your play at the moment, John?
Well, clearly, there's more risk around. I mean, we're all climbing that wall of worry, as they call it, in terms of equity markets. For us running target risk portfolios, it's obviously making sure that we stick within those guidelines, within those tram lines, of which we have from the top down. So, in other words, that if there is something unexpected in the markets, then the portfolios act and behave as within the sort of expectations of what clients have. I think if there's one thing which I think Ken is essentially alluding to, the one thing that I think all investors can do now, whether they are investing their own portfolio, outsourcing or whatever, is to look down, literally holding by holding. This is and say to yourself, why am I holding that particular holding within the portfolio? Is it diversification? Does it give me protection against inflation? Does it give me downside protection? What does it give to me in the portfolio? And really make sure that in the events that we've seen over the last 12, 18 months, you've had some periods where it's very easy to see which horse the the fund manager is riding in terms of value and growth. You've had a shoot up in value, the back end of last year. Well, if you were not a value investor, and you outperformed, I would suggest that perhaps you're doing something different within that portfolio. So you can clearly see value funds and growth funds. You can clearly see small cap and large cap funds in certain periods of the market. You can clearly see where managers are positioned for downside protection or capturing the upside. So I would look through that. I think the last thing to say is just on that bond, which is once again, diversification, believe in it. Said earlier on, expect something to go up when someone else is going down and vice versa. But I just think that a good point which has been made quite recently by one of our managers in terms of credit and duration. We talk about credit and basically, the opportunities in a economic recovery to be perhaps, further down the curve, more junky type scenario. However, the higher we go in that respect, the more equity-like we get, and therefore we have to be worried about the fact of losing effects of diversification. So that's on the credit side. And then duration. Well, clearly it makes sense that, in an environment where interest rates are probably rising, that you want to be shorter duration. Well, that's true if you're holding that asset class as a single asset class, if you want to protect yourself short duration. However, if you're holding that asset class amongst a diversified portfolio, once again, the shorter duration you go, the more equity-like you go, and the less diversification you get as well. So I'm quite wary of how much of the short duration that we have in our portfolios. And one of the things that we're continually looking at is within our fixed interest sector, what are the managers doing? Where are they relative to that duration? And quite naturally, they're looking to protect their longer-term returns. In doing so, go shorter duration. Does that help me out? No, it doesn't, because actually what it's doing is reducing the effect of my diversification in the portfolio. I think that's quite a key thing.
Interesting. You don't want to double up your bets, do you? No. If you underweight that sector and you're short duration, you're doubling the bet.
But you have this conflict, don't you? In terms of what the fund manager is trying to be the best in the sector over a certain period of time. Can't blame them for that. That's what they're trying to do. But then we have to marry that up with, hang on a minute, I'm holding a bond fund of all different flavours to provide me with diversification. If that fund manager starts moving towards shorter duration or upping the credit, then I am now getting more equity-like, and I've got to be wary about that.
Okay.
Dan, from our perspective, of course, we're often not holding funds. We're not holding corporate bond funds or fixed interest funds. We're holding the assets directly. So rather like it is with clients, the expected term of the investment is important here as well. If we're prepared to hold an asset to duration and it's sold at par at the end of that period or redeemed at par at the end of that period, then it's an actuarial calculation from our perspective. If we're prepared to pay the price today for it, knowing that the price in 10 years' time is 100p and our yield in the meantime is going to be X, if that forms a good investment for our fund, then we'll invest in it. Right. So I think this idea of holding to duration for bigger funds where you're able to is a very sensible one. The other key areas for us are, of course, around management of duration. It is important. Diversification, as I've said earlier on. And looking for, coming back to your safety question, which was what the question was about, looking for wherever it's possible to find it, and this is not easy, looking for lack of correlation between different asset classes. Now, there have to be concerns about that in a rising interest rate environment, but wherever possible to look for lack of correlation. Okay. Whether that comes from actual bricks and mortar property, whether it comes from infrastructure or the rest.
Okay. Gentlemen, thank you very much. If this has been the type of thing that floats your boat, then you could do much worse than sign up and join us at the Simplybiz Investment Services conferences, which start next week, out and about around the country. They're going to Scotland, we're going to the Midlands, where we've got a couple in the north of England and even a couple down south. There is an event near you. You will get at those events, you will get a whole host of different fund managers telling you exactly what they do, how they run their solutions. It is a delve into the supply chain of the solutions that we've pulled together within Simplybiz Investment Services. You'll get some panel debates, you will get some presentations from the individual companies telling you what's happening inside their solutions. A very hands-on day, and I will look forward to seeing you all at those events if you can make it. In about 5 minutes' time, we're back for a retirement special, looking at all things, the dynamics of the current retirement landscape in the UK. And shortly thereafter, we're getting stuck into cash in the advice process and what advisors can and should and could be doing with their clients' cash assets. So, same bat time, same bat channel, 5 minutes from now. See you soon. Thank you very much.